Good morning/afternoon/evening, everyone, and thank you for joining us today. I'm thrilled to walk you through the story of one of the most transformative companies of our era, NVIDIA Corporation. Whether you're an investor, a developer, a partner, or simply someone curious about where the future of technology is headed, you're in the right place. Let's begin with the origin of NVIDIA, a name that has become synonymous with cutting-edge innovation in AI, graphics, and high-performance computing. NVIDIA was founded in 1993 by Jensen Huang, Chris Malachowski, and Curtis Preem. What started as a vision to build graphics accelerators for gaming evolved into a revolutionary journey that redefined what computing could be. Our breakthrough came in 1999 with the invention of the Graphics Processing Unit, or GPU, a product that would go on to transform visual computing, gaming, and ultimately, artificial intelligence. Today, NVIDIA is far more than a chip company. We are a full-stack computing platform company, operating across industries with global impact. Our technologies power the visual experiences you see in games and films, but they also train large language models, run simulations for self-driving cars, and fuel breakthroughs in scientific research and drug discovery. Let's start by examining our core business pillars: gaming, data center, and automotive, along with newer ventures in Omniverse, robotics, and edge AI. 1. Gaming, our foundation. Gaming remains a foundational part of NVIDIA's identity. The GeForce brand is iconic among gamers worldwide. Our GPUs deliver immersive, high-fidelity experiences in the most demanding titles. Technologies like real-time ray tracing and DLSS, deep learning supersampling, allow games to render cinematic quality visuals at smooth frame rates. These are not just incremental upgrades. They are breakthroughs that change how we experience digital worlds. NVIDIA's influence in gaming extends beyond hardware. Through our GeForce Experience software, we provide game optimization, driver updates, and recording tools. And with NVIDIA Reflex, gamers enjoy lower latency for competitive esports. We've also pioneered cloud gaming through GeForce Now, a service that lets users stream their PC games from powerful NVIDIA servers, opening up high-end gaming to devices like Chromebooks, Macs, and even smartphones. But gaming is more than entertainment. It's also a testbed for innovation. Many of the AI and real-time rendering techniques we developed for gaming are later adapted for enterprise, simulation, and virtual environments. 2. Data center and AI, the growth engine. If gaming is our past and present, then AI is undeniably our future. Our data center business has exploded in recent years, now representing the largest share of NVIDIA's revenue. Why? Because NVIDIA GPUs, especially our H100 and A100 accelerators, are the heart of modern artificial intelligence. Let's take a moment to consider what's driving this growth. The rise of large language models, generative AI, and deep learning has created insatiable demand for compute power. Companies like OpenAI, Meta, Google, Microsoft, and Amazon rely on NVIDIA to train and deploy AI models at a massive scale. From ChatGPT and DALL-E to Google's Gemini and Meta's Llama models, they all run on NVIDIA infrastructure. What's remarkable is that we don't just sell chips, we offer a complete ecosystem. Our CUDA platform, which stands for Compute Unified Device Architecture, is the software backbone that allows developers to build accelerated applications. CUDA has become the most widely used parallel computing platform in the world, with over 4 million developers and counting. Alongside CUDA, we provide libraries like CUDNN for deep learning, TensorRT for inference optimization, and Triton Inference Server for scalable deployment. These tools enable researchers, enterprises, and startups to maximize performance and efficiency, whether they're running AI in the cloud or at the edge. And it doesn't stop there. We build DGX systems, essentially supercomputers built for AI workloads, and now we offer cloud services through NVIDIA DGX Cloud, giving enterprises access to massive AI training power without the need for on-prem infrastructure. 3. NVIDIA AI Enterprise, accelerating the AI lifecycle. To make AI accessible to all industries, we launched NVIDIA AI Enterprise, a full-stack software suite optimized for virtualized and containerized environments. Whether you're a bank building fraud detection systems or a hospital deploying medical imaging models, NVIDIA AI Enterprise ensures security, scalability, and performance. We've partnered with VMware, Red Hat, and leading cloud providers to ensure that deploying enterprise-grade AI is as seamless as possible. This positions NVIDIA not just as a technology vendor, but as a strategic partner for digital transformation across the Fortune 500. 4. Omniverse. The industrial metaverse. One of the most exciting areas of our business is NVIDIA Omniverse. Imagine a real-time, collaborative platform where designers, engineers, and AI systems can create virtual worlds, not for gaming, but for real-world simulation. Omniverse is being used by BMW to simulate entire manufacturing plants, by architects to build smart cities, and by robotics companies to train AI agents in virtual environments. It's a new frontier, the industrial metaverse, and it enables companies to design, simulate, and optimize complex systems before building them in the real world. These digital twins, accurate virtual models of physical environments, save time, reduce cost, and increase precision. And they're powered by NVIDIA's RTX GPUs, AI tools, and Omniverse connectors that integrate with industry-standard tools like Autodesk, Blender, and Siemens. 5. Automotive and robotics, AI at the edge. Let's talk about NVIDIA Drive, our end-to-end platform for autonomous driving and software-defined vehicles. From the sensor stack to the car's brain, NVIDIA Drive powers next-gen vehicles with AI. Companies like Mercedes-Benz, Jaguar Land Rover, and Volvo are building intelligent, software-upgradable vehicles with our platform. Our Drive Orin system-on-chip is capable of handling hundreds of trillions of operations per second, making it one of the most powerful processors ever built for a vehicle. Combined with our DriveWorks software stack, simulation tools, and fleet learning systems, we're enabling a safer and more autonomous future on the road. We're also helping industries deploy autonomous mobile robots using the Isaac platform, enabling applications in warehouses, hospitals, agriculture, and manufacturing. 6. Climate, healthcare, and research impact. NVIDIA's technology doesn't just fuel profits, it powers progress. In climate science, we're helping researchers build more accurate climate models using our Earth 2 initiative. In healthcare, our Clara platform is used for AI imaging, genomics, and drug discovery. And in scientific computing, NVIDIA GPUs are accelerating breakthroughs in everything from quantum chemistry to astrophysics. At the heart of it all is our commitment to enabling AI for good, using our technology to solve humanity's most pressing challenges. 7. Financial performance and investor confidence. Now, let's take a moment to reflect on our financial performance. In FY 2025, we generated over $60 billion in revenue, more than double from the year prior. Our data center business alone brought in tens of billions of dollars, and our gross margins remained robust at over 70%, an industry-leading figure. We maintain a strong balance sheet, generate healthy free cash flow, and continue to invest aggressively in R&D, nearly 20% of our revenue, because we believe innovation is the best way to future-proof our business. Our stock has appreciated dramatically over the past 5 years. Investors believe in our leadership, our roadmap, and our ability to execute. And with the growth of AI, cloud computing, and intelligent devices, NVIDIA is positioned as one of the most critical enablers of the next technological era. 8. Leadership and vision. NVIDIA is led by co-founder and CEO Jensen Huang, one of the most visionary leaders in technology today. Under his guidance, NVIDIA has not just followed market trends, it has created them. Our culture emphasizes first principles thinking, relentless innovation, and long-term focus. We don't chase quarterly headlines. We build for the decade ahead. 9. The road ahead. As we look to the future, the opportunities are staggering. Generative AI is transforming industries. The global demand for accelerated computing is rising across every sector. And countries are investing billions to secure their own AI infrastructure, many of them powered by NVIDIA. We are building the world's most advanced chips, like the upcoming Blackwell architecture, along with powerful AI supercomputers. I'm excited to take you on a deep dive into one of the most disruptive and forward-thinking companies of our time, Tesla Incorporated. Over the next 30 minutes, we'll explore Tesla's mission, its technology, business performance, innovation engine, and the vision that drives its relentless pursuit of a sustainable future. Whether you're an investor, an industry professional, a sustainability advocate, or simply a curious observer of the electric revolution, this presentation aims to connect you with the core of what Tesla is building and why it matters. Tesla was founded in 2003 with a deceptively simple mission: to accelerate the world's transition to sustainable energy. While many companies talk about disruption, Tesla embodies it. What began as a niche electric vehicle startup with the original Roadster has grown into a global energy and transportation powerhouse. Today, Tesla is not just a car manufacturer. It's a vertically integrated clean energy and technology company spanning electric vehicles, energy generation and storage, artificial intelligence, autonomy, and robotics. Let's start where most people's Tesla story begins: the electric vehicles. Tesla has revolutionized the automotive industry. From the Model S, which redefined what a luxury EV could be, to the Model 3, which helped bring electric mobility to the mass market, Tesla vehicles are designed from the ground up with performance, safety, efficiency, and software at the core. The Model X offers class-leading utility and Falcon wing doors, while the Model Y has quickly become one of the best-selling SUVs in the world, electric or otherwise. In 2023 and early 2024, Tesla sold well over 1.8 million vehicles globally, with manufacturing facilities, or gigafactories, in California, Texas, Berlin, and Shanghai, and plans underway in Mexico and other regions. Tesla's success in scaling production isn't just about volume. It's about innovation in manufacturing. The company pioneered the use of gigacasting with giant aluminum parts to simplify vehicle structures and reduce complexity. It continues to push the limits of factory efficiency with its unboxed manufacturing approach, a modular, parallelized method that could redefine how all vehicles are built. At Giga Texas, this system is being tested in real time with the production ramp of the Cybertruck, Tesla's boldest and most unconventional vehicle yet. The Cybertruck, made with ultra-hard stainless steel and built for both utility and performance, is not just a truck. It's a statement of what the future can look like when design and durability meet sustainable power. But Tesla is more than just vehicles. It's also a clean energy company. Through Tesla Energy, the company offers solar panels, the solar roof, and energy storage solutions like the Powerwall, Powerpack, and Megapack. Tesla's energy storage deployments are booming, especially with Megapacks, which are powering grid-scale projects around the world. These systems store excess renewable energy, like solar and wind, for use during high demand or outages. It's a critical piece of the transition to a decarbonized grid. Tesla is building one of the world's largest energy storage facilities in Lathrop, California, and others are in progress globally. Meanwhile, the solar roof aims to turn every rooftop into a power-generating asset. Though adoption has been more gradual, it remains a long-term focus. Now let's talk about the magic under the hood, the software. Tesla vehicles are fundamentally software-defined. Every car is connected, regularly updated via over-the-air, OTA, software updates, and continuously improving. Owners can wake up to new features, from improved range and faster acceleration to new entertainment options and safety enhancements, without visiting a service center. Tesla's full self-driving software, known as FSD, is its most ambitious bet. The company's approach is end-to-end neural network-based, powered by vision rather than LiDAR or maps. In 2024, Tesla rolled out FSD Beta V12, which now features AI models trained on billions of real-world driving miles and operates without hand-coded logic. While not yet approved as a fully autonomous system, the improvements have been substantial, and millions of miles are being driven with FSD on a daily basis. To support this, Tesla has built its own custom silicon, the FSD computer, and is now developing its own AI training supercomputer known as Dojo. Dojo is designed to train large-scale video neural networks using video data from the Tesla fleet. It's a bold bet that Tesla's vertically integrated AI infrastructure, from data collection and labeling to training and inference, will enable a breakthrough in autonomy. This same AI backbone powers Tesla Bot, or Optimus, a humanoid robot designed for manual labor and repetitive tasks. While still in early development, the potential is enormous. Tesla envisions a future where Optimus units can handle logistics, manufacturing tasks, and even assist in elder care and domestic work. Financially, Tesla remains strong. Despite economic headwinds and increasing EV competition, Tesla has consistently delivered profits, maintained healthy gross margins, and preserved flexibility through strong cash reserves and operating discipline. In fiscal year 2023, Tesla generated over $96 billion in revenue, with automotive gross margins of roughly 19%, even as it cut prices to maintain demand. Unlike traditional automakers burdened with legacy costs and dealer networks, Tesla controls its entire supply chain, distribution, and service ecosystem. This not only improves margins, but creates a more seamless experience for customers. Tesla's market capitalization, while volatile, reflects investor confidence in its long-term potential, not just as a car company, but as a platform company. Between EVs, AI, robotics, energy, and software, Tesla is building multiple businesses under one roof, each of which could stand alone in value. And Tesla's master plans, laid out in three major parts, reveal the long-term strategy. Build a sports car, use that money to build an affordable car. Use profits to build an even more affordable car. Provide zero-emission electric power generation and storage. That vision is still unfolding. In early 2024, Tesla confirmed plans to introduce a new, next-generation vehicle platform that will support its $25,000 compact EV aimed at mass affordability and global scale. This platform is expected to underpin both a traditional compact and potentially a fully autonomous vehicle. If Tesla can deliver, it will complete the final step in its decades-long strategy. Let's not forget Tesla's impact on the broader industry. It has forced legacy automakers to electrify. It has accelerated battery innovation and secured global attention on climate and energy efficiency. Companies that once dismissed Tesla are now racing to catch up. Not just in vehicles, but in software, AI, and vertical integration. Tesla has changed consumer expectations. People no longer just want a car. They want a tech product that improves over time, can be monitored from a smartphone, and feels like a piece of the future. Culturally, Tesla has built a powerful brand, not just through its products, but through its presence in the public discourse. Elon Musk, Tesla's CEO, is a central figure in the company's identity, for better or worse. His unconventional leadership style, transparency on platforms like X, formerly Twitter, and direct-to-consumer approach have helped build a loyal fanbase and stirred global conversation. While this brings volatility, it also brings visibility and authenticity rarely seen in the corporate world. So what does the road ahead look like? Tesla is aiming for 50% annual growth over a multi-year horizon. That won't come easy. Challenges include competition, geopolitical risks, regulatory hurdles, and scaling manufacturing and service globally. But Tesla's vertical integration, AI leadership, and first-mover advantage give it a unique edge. From EV affordability and autonomy to grid-scale batteries and AI robotics, Tesla continues to think a decade ahead. To close, Tesla is not a traditional car company. It's not even a traditional tech company. It's a mission-driven innovation engine, focused on solving some of the most urgent problems of our time: transportation emissions, fossil fuel dependence, energy access, and labor inefficiency. Whether it's through clean vehicles, sustainable energy, or AI-powered robotics, Tesla's goal is clear: a cleaner, safer, and more abundant future. Thank you for joining us today, and for being part of this journey towards sustainability and innovation. Good morning/afternoon/evening, and thank you for joining us today. Over the next 30 minutes, we'll explore one of the most influential, ambitious, and far-reaching companies of the modern era, Google, now known as Alphabet Incorporated. We'll take a deep dive into its businesses, innovations, financial strength, AI leadership, and the vision that continues to shape our digital world, and increasingly, the physical one too. Let's begin with a little history. Google was founded in 1998 by Larry Page and Sergey Brin while they were PhD students at Stanford University. Their goal was simple but bold: to organize the world's information and make it universally accessible and useful. What started as a research project became a global phenomenon. And more than 2 decades later, that mission still drives everything Google does, only now, the scale is planetary, and the technologies are revolutionary. Today, Google is the largest subsidiary of its parent company Alphabet Inc., which was formed in 2015 to house not only the core Google business, but also a series of ambitious ventures, known as Other Bets, ranging from self-driving cars to life sciences. At the heart of it all is a relentless focus on innovation, grounded in AI, fueled by data, and deployed at global scale. Let's begin with Google's core, search. More than 90% of the world's online queries go through Google Search. It's a product used by over 4 billion people globally. Search is no longer just about typing questions, it's multimodal. With advancements in natural language processing, voice recognition, and now AI-powered search, people can interact with Google in increasingly intuitive ways. Google Lens, for example, allows users to search visually by taking photos of objects or text. And with generative AI now integrated into search through Search Generative Experience, SGE, the results page is becoming more conversational, more helpful, and more human-like. But search is just one part of a much broader ecosystem. Google owns and operates Android, the world's most widely used mobile operating system, powering over 3 billion devices worldwide. The Google Play Store is a central distribution channel for millions of apps and games. Through Android, Google reaches billions of people, not just with phones, but with wearables, cars, TVs, and even embedded smart home devices. Then, there's YouTube, the second largest search engine in the world, and the dominant force in online video. With over 2.7 billion monthly logged-in users, YouTube is a cultural and economic engine. It supports millions of content creators, businesses, and advertisers. It's where people go to learn, to be entertained, and increasingly, to shop and even find jobs. YouTube Shorts, Google's answer to TikTok, now sees over 70 billion daily views, and it's driving major engagement among younger audiences. Now let's talk about Google's biggest moneymaker, advertising. Google Ads, Search Ads, YouTube Ads, and the broader Google marketing platform represent one of the most sophisticated digital ad ecosystems in the world. In 2023 alone, Alphabet generated over $320 billion in revenue, with more than 75% of that coming from advertising. The scale, precision, and ROI of Google's ad tools have made it indispensable for millions of businesses, from global brands to local shops. However, advertising is only one engine. Another massive and rapidly growing business is Google Cloud. This division, which includes Google Cloud Platform (GCP) and Google Workspace, has grown to become a major pillar of Alphabet's future. In 2023, Google Cloud crossed over $35 billion in annual revenue, and more importantly, it reached operating profitability, a milestone Wall Street had been watching closely. Google Cloud offers enterprise-grade infrastructure, data analytics, cybersecurity, through Mandiant, and AI tooling for organizations of every size. It powers companies like PayPal, Twitter/X, Target, and even governments. Meanwhile, Workspace, which includes Gmail, Docs, Meet, and Sheets, serves over 9 million paying organizations, providing the productivity backbone for the modern hybrid workforce. A huge driver of both cloud and consumer-facing products is Google's leadership in artificial intelligence. In fact, you could argue that Alphabet is fundamentally an AI-first company. Google has been investing in AI for over a decade, and those investments are now front and center. At the heart of this AI transformation is Google DeepMind, the research lab responsible for breakthroughs like AlphaGo, AlphaFold, and now Gemini, Google's family of large multimodal models that compete directly with GPT and other foundation models. Gemini is deeply integrated across Google's ecosystem, from search to Gmail, Docs to Android. The Gemini 1.5 series brings long context understanding, video comprehension, and coding capabilities to a range of products and services. In fact, Gmail with Gemini can summarize threads, draft responses, and automate routine tasks. Docs with Gemini becomes a real-time writing partner. YouTube with AI can generate descriptions, detect chapters, and even flag policy issues automatically. For developers and enterprises, Google offers Vertex AI, a platform within Google Cloud that enables the development, deployment, and management of custom AI models. Vertex AI is powering everything from chatbots and predictive models to content generation and recommendation systems. On the hardware side, Google continues to innovate. The Pixel line of smartphones, now in its 8th generation, features custom Tensor chips optimized for on-device machine learning. Pixel is gaining ground in North America and Europe, especially among Android loyalists. Alongside Pixel, Google is building a broader hardware ecosystem, including the Pixel Watch, Pixel Buds, and Nest smart home devices that deliver Google software and AI in physical form. Alphabet also continues to pursue ambitious long-term bets through its Other Bets segment. One of the most prominent is Waymo, a leader in autonomous driving. Waymo operates fully driverless robot access in cities like Phoenix and San Francisco, and is expanding rapidly. With billions of autonomous miles under its belt, Waymo is positioning itself as a platform for the future of mobility, safer, cleaner, and more efficient. Another bet is Verily, focused on life sciences and healthcare technology. From chronic disease management to clinical research platforms, Verily aims to bring AI and data science to the most pressing health challenges. Meanwhile, Calico focuses on longevity and the biology of aging. X, the so-called Moonshot Factory, incubates projects like high-altitude internet balloons, formerly Loon, wireless power, and next-gen robotics. Let's take a moment to look at Alphabet's financial strength. In 2023, Alphabet reported over $320 billion in revenue, with net income exceeding $75 billion. It holds over $100 billion in cash and marketable securities, giving it enormous strategic flexibility. The company returned tens of billions to shareholders through stock buybacks and continues to invest aggressively in R&D, over $40 billion annually. This level of financial performance gives Alphabet the ability to take long-term risks, withstand macroeconomic shocks, and double down on innovation even during uncertain times. Few companies have this combination of profitability, technical talent, and user reach. Alphabet's leadership is also an important asset. CEO Sundar Pichai has guided the company through a period of rapid technological change, antitrust scrutiny, and organizational evolution. Known for his calm demeanor and product-first mindset, Pichai has emphasized responsible AI, user privacy, and the importance of aligning innovation with societal values. Under his leadership, Alphabet has become more focused, efficient, and execution-oriented. Of course, Alphabet faces challenges. Regulatory scrutiny is intensifying in the US, EU, and elsewhere. Antitrust lawsuits related to its ad dominance and default status on mobile devices are ongoing. Competition in AI is fierce, from OpenAI, Microsoft, Meta, and startups. And the digital advertising landscape is evolving, especially with changes to privacy, third-party cookies, and user tracking. But Google is adapting. It's building Privacy Sandbox to support advertising without compromising user privacy. It's expanding Gemini and open sourcing some of its models. And it's growing its enterprise and hardware businesses to diversify revenue. So what does the future look like for Google and Alphabet? We're witnessing a transformation, not just of Google, but of how the world interacts with technology. Alphabet is building the foundation for the AI era, from chips and models to interfaces and safety tools. It's helping billions of people be more productive, informed, creative, and connected. And it's doing so across languages. Microsoft is not just back, it's dominant. It's arguably the most strategically positioned company in the world right now. And over the next 30 minutes, I'm going to walk you through exactly why, with numbers, strategy, and fundamentals to back it up. Let's start with the macro view. Microsoft is a $3.5 trillion company as of mid-2025. It has grown from a legacy software giant into a full-spectrum digital infrastructure and AI powerhouse. Under Satya Nadella's leadership, Microsoft has turned its aging reputation into a strategic asset, combining cloud, AI, enterprise trust, and recurring revenue into a business model that's as scalable as it is defensible. We're talking about a company with over $260 billion in annual revenue, growing at double-digit rates. A company with gross margins north of 68%, operating margins over 40%, net income exceeding $95 billion, and over $80 billion in free cash flow annually. That's not just good, that's elite. And unlike many tech peers, Microsoft delivers GAAP profits consistently, returns capital to shareholders through dividends and buybacks, and still outinvests rivals in R&D. So what drives this juggernaut? It comes down to three strategic flywheels: Microsoft Cloud, AI integration, and Azure OpenAI. Enterprise software ecosystem. Let's break it down. 1. Microsoft Cloud, a $140 billion engine. Microsoft Cloud, including Azure, Microsoft 365, Dynamics 365, LinkedIn, and GitHub, is now generating over $140 billion in annualized revenue. It is the single most important franchise in enterprise technology today. Let's talk about Azure, Microsoft's public cloud platform. Azure is growing faster than AWS on a larger base in many quarters. It has over 65% of the Fortune 500 using its services for mission-critical workloads. Azure is now not just an infrastructure provider, it's a full-stack ecosystem: compute, data, security, analytics, DevOps, AI, IT, the whole enterprise fabric. And then there's Microsoft 365, the productivity suite that's become embedded into how modern business operates. With over 400 million paid seats and growing, Microsoft is the de facto operating system of knowledge work. Now infused with Copilot AI, it's unlocking new productivity layers, automating documents, summarizing emails, and reimagining meetings. 2. AI and OpenAI partnership, the ultimate strategic bet. Let's be aggressive here. Microsoft is not just a player in AI, it's the platform. The partnership with OpenAI, including a $13 billion investment and deep Azure integration, was one of the smartest, most aggressive moves in tech history. Microsoft didn't just fund OpenAI. It embedded GPT models into its stack faster and deeper than anyone else. And now, GPT-4, GPT-4o, and future models are being trained and deployed on Azure supercomputing clusters. That's recurring usage. That's infrastructure dominance. AI is now core to everything Microsoft does. Microsoft Copilot is live across Word, Excel, Teams, PowerPoint, Outlook, GitHub, and Dynamics. GitHub Copilot is rewriting the way software is developed, with over 1.5 million active developers using AI-assisted coding. In security, Microsoft Security Copilot is transforming incident response and threat hunting. This isn't experimental. This is revenue-generating AI at scale. Even better? Microsoft is monetizing AI not just through usage, but via $30/user/month Copilot licenses, layered on top of enterprise contracts. This is pure margin expansion. 3. Enterprise ecosystem, depth, stickiness, and control. Microsoft owns the enterprise stack. Full stop. From Windows and Azure AD to Office, Teams, SharePoint, Dynamics, Power Platform, and Intune, Microsoft is the most deeply embedded IT vendor in the world. Switching costs are massive. Integration runs deep. And trust is high. Let's be honest, CIOs don't want 10 vendors anymore. They want security, compliance, data governance, and AI from one trusted vendor. That's Microsoft. And it's why Microsoft wins multi-year, multi-million-dollar cloud deals week after week. The cross-sell opportunity is insane. If you start with Microsoft 365, you expand to Teams, add security, move your data to Azure, layer in Copilot, and suddenly, you're spending 20 to 30% more per employee, year over year. Microsoft Teams alone now has over 320 million monthly active users. It has replaced Slack in most large companies. Power Platform, Microsoft's low-code/no-code tool, has over 10 million monthly makers building apps and automations. That's not just innovation, that's platform lock-in. Financial fundamentals, Microsoft is a compounder. Let's get serious about the numbers. Revenue, over $260 billion, 2025 estimate. Operating margin, 42%. Net income, over $95 billion. Cash reserves, $140 billion. Dividend yield, steady growth, with 10% annual dividend increases. Share buybacks, $20, $30 billion/year. Return on invested capital, 30% plus. Debt to EBITDA, less than 1x. Extremely healthy. Microsoft has one of the strongest balance sheets in corporate history. It can buy back shares, invest in R&D, acquire strategic assets, and still outcompete. And it's done all of this while preserving pricing power and growing margins. Strategic acquisitions, beyond just growth. Microsoft is not afraid to make bold moves. The $69 billion acquisition of Activision Blizzard wasn't just about gaming. It was about content, IP, and reach. Now, Microsoft owns Call of Duty, World of Warcraft, Candy Crush, and more, giving Xbox and Game Pass massive leverage. More importantly, Microsoft is building cloud gaming infrastructure through Xbox Cloud, leveraging Azure to stream AAA titles on any device. With a global gaming TAM, total addressable market, over $200 billion and rising, Microsoft is in a prime position to dominate cross-platform interactive content. Other strategic moves? LinkedIn continues to grow revenue at double digits, already over $15 billion per year, making it the largest professional platform in the world. Nuance, the speech AI company, powers Microsoft's healthcare and voice AI push. And GitHub has over 100 million developers, and it's core to Microsoft's developer strategy. AI chips and infrastructure, going vertical. Microsoft isn't stopping at OpenAI and Azure. It's building its own AI chips, the Azure Maya and Azure Cobalt processors, optimized for large model training and inference. Why? To reduce reliance on NVIDIA and improve cost/performance at hyperscale. Microsoft is going vertical, just like Apple. In 2025, Microsoft is expected to deploy dozens of new AI data centers across North America and Europe, powered by renewables, optimized for AI compute, and built for multi-decade demand. This isn't just infrastructure, it's national-scale strategic AI capacity. Geopolitical and regulatory advantage. Microsoft is arguably the most politically favored big tech company today. Unlike Meta, Google, Amazon, or Apple, Microsoft has avoided most antitrust disasters. Why? Because it plays the long game, cooperates with regulators, and maintains high trust with governments and enterprises alike. It's deeply embedded in federal IT, education, defense, and healthcare. Its AI principles, focused on transparency, fairness, and security, are influencing global AI regulation. It's not just building the tools of the future, it's helping define the rules. Why Microsoft will continue to dominate. Let's recap why Microsoft is winning now, and will continue to win. It has recurring revenue from Office, Azure, LinkedIn, and more. It owns enterprise relationships and offers cross-platform synergies no one else can. It is monetizing AI faster than anyone, and profitably. It has enormous scale in both consumer and enterprise markets. It controls its distribution, infrastructure, software, and increasingly its AI chips. It has a world-class balance sheet and deep operating leverage. And most importantly, it's everywhere without being everywhere. Microsoft wins because it integrates, augments, and adapts. It doesn't demand attention, it delivers results. Final thought. Microsoft is not a turnaround story anymore. It's not a growth stock by surprise. It's a core compounder, a platform play, and the operating system for the enterprise AI economy. Satya Nadella has turned this company into the most essential technology provider on Earth. So when you're thinking about long-term winners, the companies that will shape how we work, build, learn, govern, and innovate, Microsoft is not optional. It's inevitable. A company that is now evolving to reclaim leadership in a highly competitive fintech landscape. I'm talking about PayPal Holdings Incorporated. And while the narrative around PayPal has shifted in recent years, marked by competitive pressure, management changes, and margin compression, the core fundamentals remain strong, and the strategic upside is very real. Let's be direct. PayPal has been through a rough valuation reset. But don't confuse price with performance. This is a company with over 400 million active accounts, processing more than $1.5 trillion in annual total payment volume, TPV, generating over $30 billion in revenue, and producing billions in free cash flow. PayPal isn't shrinking. It's evolving. And that evolution is what today's conversation is all about. 1. The core business, scaled, global, and embedded. At its core, PayPal is a payments infrastructure company. It's the layer between the consumer, the merchant, and the financial network. It enables secure, fast, and trusted transactions across more than 200 markets and 100 currencies. And it's available in more digital checkout environments than almost any other brand. PayPal processes transactions through several key properties. PayPal branded checkout, the flagship product, used at millions of merchant sites. Braintree, the unbranded white-label gateway used by enterprise merchants like Uber, Airbnb, and DoorDash. Venmo, a peer-to-peer social payments platform with 90M+ users, increasingly used for commerce. Xoom, the cross-border remittance business. PayPal Commerce Platform, PPCP, a comprehensive merchant services suite. And the recent launch of PayPal Complete Payments, a rebuilt, modernized payment stack designed to compete directly with Stripe and Adyen. PayPal processes over 6 billion transactions per quarter, with average TPV per active account rising steadily. That's massive embedded scale, the kind that takes decades to replicate. 2. Financial fundamentals, profitable, cash-generating, leaning in. Now let's talk numbers. In FY 2024, PayPal generated $30+ billion in revenue, $5.5 billion in operating income, nearly $5 billion in free cash flow, transaction margins of 49%, $1.2 trillion in branded TPV alone, over 220 million monthly active accounts. Gross margin has faced pressure due to mix shift toward Braintree and competition on fees, but PayPal's new leadership is aggressively rationalizing cost, cutting underperforming products, and focusing on operational excellence. PayPal trades at a low double-digit forward PE, deeply discounted compared to other fintechs, despite superior cash generation. This makes it a compelling value story with optionality from product reinvention, AI, and international expansion. 3. The turnaround strategy under new CEO Alex Chriss. In 2023, PayPal brought in Alex Chriss, a former Intuit executive, known for building Intuit's small business and self-employed group into a multi-billion-dollar growth engine. Chriss has laid out a clear and focused strategy. Rebuild the core checkout experience, with faster, API-first, modular solutions through the PayPal Complete Payments platform. Reignite Venmo, shifting it from peer-to-peer to peer-to-business, with a deeper focus on monetization, ads, and commerce. Simplify and streamline the product portfolio, cutting overlap and legacy drag. Double down on AI across fraud detection, risk, customer support, and merchant insights. Enhance value for merchants with better data, actionable analytics, and tailored marketing tools. Improve branded PayPal checkout adoption with single-click login, identity-as-a-service features, and performance parity with Apple Pay. This is not a pivot, it's a realignment around profitable core use cases, modern architecture, and merchant trust. For competitive landscape, Stripe? Adyen? Apple Pay? Yes, but PayPal is fighting back. Let's address the elephant in the room, competition. Yes, PayPal is under pressure. From Apple Pay, Stripe, Adyen, Square, even buy now pay later platforms like Affirm. But competition is not a death sentence. It's a forcing function for reinvention. Apple Pay is dominant in iOS, but it's hardware-bound, US-centric, and not nearly as merchant-friendly outside of NFC. Stripe is powerful, but primarily developer-first. PayPal is leaning back into its strength, consumer trust plus merchant breadth plus global reach. And PayPal has something most of these challengers don't: brand equity. A 2024 consumer study showed that PayPal increases checkout conversion by 25% plus across many verticals, especially in cross-border and mobile. That is not just a convenience, it's a revenue multiplier for merchants. That's why PayPal is still a must-have integration, especially for SMBs and international sellers. 5. Venmo, monetization engine in the making. Venmo is more than a social payments app. It's a commerce platform in disguise. With over 90 million users and strong millennial/Gen Z penetration, Venmo is expanding beyond P2P. Business profiles for small merchants and creators. Integrated checkout for merchants. Co-branded credit cards. Instant transfer fees. Pay with Venmo partnerships, Uber, Amazon, etc. Under the new strategy, Venmo is being refocused toward monetization and embedded financial services, without bloating the app. Think social plus trust plus payments plus commerce. 6. AI and fraud, strategic differentiation. PayPal operates at massive scale, and that scale feeds proprietary data across fraud patterns, transaction types, and behavioral signals. With millions of data points per second, PayPal is leaning into AI or ML to reduce fraud loss, boost authorization rates, and improve customer support. The company is also deploying generative AI in smart dispute resolution, personalized merchant dashboards, automated responses, and routing in customer service, dynamic checkout optimization. This isn't theoretical, it's live, and it's improving KPIs. Laid out a clear and focused strategy. Rebuild the core checkout experience with faster, API-first, modular solutions through the PayPal Complete Payments platform. Reignite Venmo, shifting it from peer-to-peer to peer-to-business, with a deeper focus on monetization, ads, and commerce. Simplify and streamline the product portfolio, cutting overlap and legacy drag. Double down on AI across fraud detection, risk, customer support, and merchant insights. Enhance value for merchants with better data, actionable analytics, and tailored marketing tools. Improve branded PayPal checkout adoption with single-click login, identity-as-a-service features, and performance parity with Apple Pay. This is not a pivot, it's a realignment around profitable core use cases, modern architecture, and merchant trust. For competitive landscape, Stripe? Adyen? Apple Pay? Yes, but PayPal is fighting back. Let's address the elephant in the room, competition. Yes, PayPal is under pressure. From Apple Pay, Stripe, Adyen, Square, even buy now pay later platforms like Affirm. But competition is not a death sentence, it's a forcing function for reinvention. Apple Pay is dominant in iOS, but it's hardware-bound, US-centric, and not nearly as merchant-friendly outside of NFC. Stripe is powerful, but primarily developer-first. PayPal is leaning back into its strength: consumer trust plus merchant breadth plus global reach. And PayPal has something most of these challengers don't: brand equity. A 2024 consumer study showed that PayPal increases checkout conversion by 25% plus across many verticals, especially in cross-border and mobile. That is not just a convenience, it's a revenue multiplier for merchants. That's why PayPal is still a must-have integration, especially for SMBs and international sellers. 5. Venmo, monetization engine in the making. Venmo is more than a social payments app. It's a commerce platform in disguise. With over 90 million users and strong millennial/Gen Z penetration, Venmo is expanding beyond P2P. Business profiles for small merchants and creators. Integrated checkout for merchants. Co-branded credit cards. Instant transfer fees. Pay with Venmo partnerships, Uber, Amazon, etc. Under the new strategy, Venmo is being refocused toward monetization and embedded financial services, without bloating the app. Think: social plus trust plus payments plus commerce. 6. AI and fraud, strategic differentiation. PayPal operates at massive scale, and that scale feeds proprietary data across fraud patterns, transaction types, and behavioral signals. With millions of data points per second, PayPal is leaning into AI or ML to reduce fraud loss, boost authorization rates, and improve customer support. The company is also deploying generative AI in smart dispute resolution, personalized merchant dashboards, automated responses, and routing in customer service, dynamic checkout optimization. This isn't theoretical, it's live, and it's improving KPIs. Walmart is not just a retailer. It's not just a grocery chain or a discount warehouse. Walmart is one of the most operationally disciplined, logistically advanced, and strategically evolving companies in the world. For a long time, the narrative was that Walmart would be disrupted by Amazon, that it was too slow, too old, too physical. But the reality is this: Walmart has outlasted dozens of disruptors, embraced technology with brutal focus, and built a business model that is incredibly hard to replicate. Let's unpack why Walmart, now a $540 billion revenue behemoth, with over 10,000 stores across 19 countries, 240 million customers a week, and a growing e-commerce and advertising business, is still one of the most underappreciated strategic giants in the modern economy. 1. Walmart's core strength: U.S. retail dominance at scale. Walmart is the #1 retailer in the U.S., the largest private employer in the world, and the second largest e-commerce platform in America behind Amazon. With over 4,600 U.S. stores, 90% of Americans live within 10 miles of a Walmart. That proximity? It's not just convenience. It's strategic infrastructure. It means faster delivery, lower logistics cost, and better inventory management than nearly anyone else. The store is no longer just a point of sale. It's a fulfillment hub, a return center, and an omnichannel engine. Walmart US is still the profit core, driving mid-single-digit comp sales, with membership boosts via Walmart Plus and strong margin expansion through private label and supply chain optimization. 2. Walmart Plus and omnichannel retail, the Amazon killer. Let's talk about Walmart Plus, the subscription service that bundles free shipping, gas discounts, mobile scan and go, Paramount Plus streaming, RX savings. It now has over 30 million members, and it's growing steadily. It directly targets Amazon Prime, but leverages Walmart's physical footprint as an edge. And this is key: Walmart has merged online and offline seamlessly. Order online, pick up in store. Shop in store, return online. Delivery from store in under 2 hours. In 2024, Over 50% of all U.S. digital orders were fulfilled by local stores, reducing last-mile cost and increasing same-day coverage. Amazon can't do that at scale. This is omnichannel retail mastery, and it's paying off. 3. E-commerce plus marketplace. Quietly massive. While Amazon gets the headlines, Walmart has built a $100 billion e-commerce business, growing double digits year over year. It's now the second largest online retailer in the U.S., ahead of Apple, Target, and Best Buy. Walmart Marketplace is its seller platform, similar to Amazon's 3P model. Thousands of merchants now sell via Walmart.com, with integration into Walmart Fulfillment Services, WFS, advertising, and analytics. Walmart's acquisition of Jet.com, Flipkart in India, and stakes in PhonePe, Symbotic, and more, has built a global e-commerce portfolio that's diversified, scalable, and increasingly AI-enhanced. In India, Flipkart and PhonePe are now dominant. PhonePe processes over 5 billion UPI transactions a month and is a potential fintech breakout story. 4. Supply chain, automation, and AI. Walmart's quiet superpower. What makes Walmart unbeatable? One word: operations. Over 210 massive distribution centers. AI-powered demand forecasting. RFID-based inventory tracking. Autonomous forklifts and robotics. Drone delivery pilots. Real-time logistics dashboards across the globe. In partnership with Symbotic, Walmart is automating over 40 regional distribution centers, reducing labor costs, speeding throughput, and driving better margin structure. Walmart isn't guessing where items go. It knows, in real time, across a $500 billion plus supply chain. That's not just scale. That's precision logistics at global level. 5. Advertising and data monetization, high-margin growth. This is where the future gets exciting. Walmart now has a rapidly growing ad tech business, Walmart Connect. Brands pay to promote on Walmart.com, in-store digital signage, the Walmart app, and across media networks linked to Walmart shopper data. In 2024, Walmart Connect generated over $3 billion in high-margin revenue, growing at 30% plus annually. It's already the second largest retail media network in the U.S. behind Amazon. With first-party data from 100 plus weekly U.S. shoppers, Walmart is sitting on a data goldmine. As privacy rules restrict cookie tracking, retail media is the future of targeted advertising, and Walmart is in pole position. 6. International expansion, emerging market leverage. Walmart is not just a U.S. story. It has dominant assets in Mexico, Walmex; India, Flipkart and PhonePe; Chile and Central America; China, with smart city retail pilots; Canada, a consistent growth contributor. India is the crown jewel, with over 1.4 billion people, rising internet penetration, and digital payments exploding. Flipkart is positioned to be India's Amazon meets Alibaba, while PhonePe dominates UPI. Walmart's international footprint is now leaner, more digital, and more profitable than it was 5 years ago, thanks to divestitures in the UK and Argentina and an intense focus on core growth markets. 7. Financial strength, world-class fundamentals. Let's talk numbers, because Walmart's financials are rock solid. FY 2025 revenue, $648 billion TTM. Operating income, $26 billion. Free cash flow, $14 billion. Dividend yield, 1.4%, growing for 50 years. Share repurchases, $10 B/year average. Return on equity, 18%. Net debt to EBITDA, under 2x. Walmart combines scale, cash flow, and discipline better than almost anyone. Its ability to invest, return capital, and remain cost competitive simultaneously is rare, especially at global scale. 8. ESG, labor, and sustainability, strategic advantage. Walmart has turned what was once a PR risk, labor, sourcing, environmental footprint, into a strategic moat. 100% of stores powered by renewable energy by 2035. Zero-emission supply chain. Target by 2040. $15 plus minimum wage across many states. Leader in sustainable packaging and supplier engagement. AI tools to reduce food waste, energy usage, and shelf gaps. In an era of stakeholder capitalism, Walmart's ESG initiatives enhance brand trust, reduce risk, and support long-term durability. 9. The competitive moat. Why Walmart is built to win. Let's sum up the competitive advantages. White heavy checkmark global scale. White heavy checkmark store plus digital hybrid model. White heavy checkmark AI-driven supply chain. White heavy checkmark private label expansion. White heavy checkmark membership model with Walmart Plus. White heavy checkmark logistics and fulfillment ownership. White heavy checkmark high margin retail media. White heavy checkmark deep grocery footprint. White heavy checkmark emerging market growth. White heavy checkmark financial discipline. This is a fortress business, with the agility of a startup layered onto the backbone of industrial strength retail. Final take. Walmart isn't just surviving, it's leading. There was a time when analysts doubted Walmart's future, said it couldn't out-Amazon Amazon. But what we've seen over the past decade is clear. Walmart adapts. Walmart executes. Walmart wins. In a world of rising prices, uncertain consumer behavior, and fragmented retail, Walmart remains the essential, everyday retailer, but with more tech, more reach, more intelligence, and more upside than ever before. This isn't your grandfather's Walmart. This is a digital, data-driven, distribution-optimized super company, with the scale of a government, the efficiency of a logistics firm, and the reach of a tech giant. Walmart isn't going anywhere. It's going everywhere.